We're seeing a bit of a pullback in the markets today, and that's after yesterday's strong gains. Do you think just a bit of profit taking here?
I think there is a bit of profit taking coming in. If you take a look at the Dow yesterday, 1.3% up. It was actually the lightest volume that the Dow's seen in 6 weeks. So moving up on very thin volumes, and I think when people do see that very thin volume, they will come to take a little bit of profit out, because it's not always the strongest sign in the market. So profit taking definitely coming in. We saw early this morning when the market opened that there was also a lot of selling that came into the market. But now since the GDP figure came out, we see the buying come back into the market. But definitely profit taking. We've got a holiday in the States on Thanksgiving Thursday, so it's going to be quite thin for the whole week.
Of course, we are entering silly season, so we can expect these volumes to start tapering off, can't we?
Yes, definitely. It's going to be a slow week, and we've had very thin volume really for the last good few weeks. So the volume is just not consistent, and it's quite choppy. So I think that for the next into the end of the year, we're still going to see choppy and thin volume.
Of course, we did see the US markets taking heart yesterday from better than expected home sales figures, best figures in about 2.5 years, I was reading. And of course, we have more US data out this afternoon, including GDP as well, and also consumer confidence. Do you think that could give the markets an additional spark as we head into the week?
A good GDP number out of the States will definitely help the markets. I still think that the markets have run up excessively hard, and we're starting to get to a point where they're battling to get any higher than they are. So good figures definitely will help and keep us at these levels. Obviously poor figures, we'll have to see how the market reacts to that. And will high volume come through if there are negative figures?
Of course, we know that a lot of the buying in the South African market has really been foreign buying, and really due to the dollar carry trade. But that dollar-euro is struggling to break through 150 and also going back down to the 148 level. Do you think there's a risk there for our market with that?
Definitely. I think that if the euro can't break that 150 level and starts to weaken against the dollar, and we see it go 148.50 all the way below 148 to the dollar, we can see some of that carry trade being taken off and money putting back into the dollar side. So it is something to look at, and a big risk for our market as that euro starts to weaken and breaks those levels against the dollar. The carry trade will come off slightly, and that will be big volume in the South African market.
Well, we had a few results out today, and also late yesterday we had results out from Telkom. Basic earnings a share down 141%, so not very good numbers from Telkom, and the market didn't receive them very well either, did it?
No, not really. If you take a look at their operating revenue, it was up 4%, which is quite good. The problem is that their operation expenses have moved up 12%, which is worrying, and at the same time, voice revenue is down 9%. So obviously they've got a lot of headwinds, and there's just no real pickup for Telkom at the moment. And currently with the stock around 38, 39 Rand, it is a little bit pricey. I'd only re-enter that trade if you see Telkom down at around the 35 Rand level.
Tiger Brands headline earnings a share from continuing operations up 20%, but this is quite a defensive stock, isn't it?
It is very defensive. Looking at it at a very brief level, it looks like very good numbers, but if you take a slightly deeper look in, one or two abnormal items that help to get that revenue up. So not the best figures from Tiger Brands. The one positive thing is that they are starting to spend on some capex. They're spending about $500 million on a new wheat mill, and they are very strong in the grain sector and the wheat sector. And in difficult markets, people are changing their diet to grains and to the wheat sector. So we think that it's a good capex expenditure that they're going to be putting through. And you know, they're very slow to put in very high capex expenditure previously. So looking quite good for them in that respect.
Mm-hmm. We were chatting to some analysts this morning, though, and they thought the Tiger Brands share price at current levels was probably quite fully priced. What's your view, Rob?
A year out, we've got it a target level of 170 Rand. It's trading at 160 currently, so upside of about 6%. So it is nearly fully priced, and I wouldn't see it as a growth stock. Yes, defensive in the market coming down, definitely something to look at. But for a big growth position, we think there's only about 6% left on the upside. Just
finally, Rob, Adcock Ingram headline earnings a share up 16%, and of course another defensive stock.
Defensive stock, but also a defensive and a growing stock. We see that they're going to start getting, well, they say they're going to be getting more antiretroviral business going through. I think very good. If you take a look at its peer, Aspen, also growing quite extensively. They can also move out of South Africa as well, so we like Adcock Ingram.